Hi, I'm Daniel Barriga. Thank you for joining me on the launch of this new format. In this new series, we'll be reviewing the most relevant updates across the sports and finance industry, focusing on what's happening off the pitch from a business and investment perspective. Let's start with this week's key updates from the sports and finance industry. Starting in Europe with German football, the DFL Deutsche Fußballliga has released its full financial documentation for the 24-25 season, and the numbers confirm a record year for German professional football. According to the report, the combined revenues of the Bundesliga and Bundesliga 2 reached 6.3 billion euros, being the first time German professional football has gone beyond the mark of the 6 billion euros. Compared to last season, that's a 7.9% increase, roughly 460 million euros more than the year before, confirming that the growth has been continued and accelerated since the pandemic. Looking at the breakdown, the Bundesliga generated 5.12 billion euros in revenue, while Bundesliga 2 contributed 1.1 billion euros, both divisions being at the highest revenue levels ever. Attendance remains one of the core strengths of the German model across both leagues. Close to 21 million tickets were sold during the season. Stadium occupancy remains consistently high, and that continues to be a structural advantage compared to other major European leagues. On the financial sustainability side, the figures are also telling. 13 Bundesliga clubs and 15 Bundesliga 2 clubs reported profits. On an EBITDA basis, almost all clubs across both divisions finished the season in positive territory. The documentation also highlights the broader economic impact of professional football in Germany, generating more than 1.6 billion euros in taxes and social contributions during the season and supporting over 64,000 jobs. The full report adds transparency around cost structures, wages and revenue distribution, and reinforces the Bundesliga reputation for financial discipline within European football. Moving to the global sports industry, we've seen a significant ownership move in the sportswear sector, with Anta Sports agreeing to acquire a 29% stake in Puma in a transaction valued at around 1.5 billion euros. The stake is being acquired from Group Artemi, the investment vehicle of the Puma family, which has historically been Puma's largest shareholder. As part of the transaction, the Pinol family will reduce its holding but will remain a significant shareholder in the company. The deal values Puma shares at 35 euros per share, representing a substantial premium compared to where the stock was trading before the announcement. Once the transaction is completed, Anta will become Puma's largest single shareholder. A key detail here is that Anta's stake remains just below the 30% ownership threshold under German law that would trigger a mandatory takeover offer. Anta has stated that it does not currently plan a full acquisition of Puma, although it may seek representation on the company's supervisory board once the deal is closed. Following the transaction, Puma's shareholder structure will be led by Anta as the largest individual shareholder, with the Pinot family retaining a reduced but still meaningful position. The remaining shares continuing to be held by institutional and public market investors. Market reacted positively to the announcement, with Puma shares moving higher following the news, suggesting investors see the strategic value in the new ownership structure. From Anta's perspective, this move fits into its broader international expansion strategy. The group is already operating a multi-brand portfolio that includes Fila in mainland China, as well as brands such as Descent and Jack Wolfskin. Taking a significant minority position in Puma adds a major European sportswear brand to that portfolio and strengthens Anta exposure to global distribution and brand equity outside China. For Puma, the timing is also relevant, with the company being operating in a highly competitive environment and has recently implemented restructuring measures aimed at improving efficiency and restoring growth momentum. Bringing in a long-term strategic shareholder could provide additional stability as the brand navigates this phase. More broadly, this transaction is another clear example of continued cross-border capital flows in the global sports industry, particularly between Asian investors and established European brands. Finally, third new, in Middle East terms, there's a very strong financial update from one of the region's flagship football organizations. Al Hilal Saudi Football Club released this week its official annual financial results for the 24-25 season, showing concrete growth across multiple revenue streams and a clear path towards commercial sustainability. According to the report, the club's total revenue increased to around 1.2 billion reals, approximately $340 million, up from about 1 billion reals last season, representing roughly a 17% increase in total revenue year on year. Profitability also improved, with net profit rising about 30% to SAR 40 million reals compared to prior year. Breaking down income sources shows a clear shift toward diversified commercial performance. Sponsorship revenues alone accounted for about 40% of total revenue, increasing to roughly 500 million reals and remaining the single largest contributor to the club's top line. Revenue from championships, rankings, and cups also delivered a strong boost, growing by around 125%. Television broadcast-related revenues contributed for the first time in this reporting cycle. Fan engagement on match days reflected the club's commercial momentum, with attendance rising nearly 80% year on year, a significant jump that supports both matchday income and broader hospitality and experience offerings. What makes these figures notable beyond pure growth is how they position Al Hilal in a global context. With revenues of this magnitude, the club's commercial output would place it among the top 20 clubs globally if compared to European revenue leagues, a benchmark that underscores how Saudi clubs are closing the gap with traditional power horses. For sponsors, broadcasters, and investors, these results send a clear signal. Middle East clubs can now produce transparent, quantifiable financial performance and not just headline signings or big match results. Al Hilal figures reflect a broader commercial maturity in the regional sports ecosystem, one where strategic revenue, global media exposure, and fan monetization are becoming core pillars of long-term growth. That's it for today. I hope you have enjoyed this first edition of our new format.